My name is Andrew Stotts, and I want to welcome you to another presentation of Evaluation Masterclass Bootcamp Graduate. This one is an exciting one. Now we're shifting into the energy space, and I want to invite him in right now. Raj, how are you doing?
Good, very well. Thank you, Sir Andrew.
Yeah, I'm really looking forward to this. In the last presentations we had the truck companies. Now it's time to shift gears and look at what these truck companies consume.
Absolutely.
Yeah. So let me bring up your PowerPoint. Okay. So I see your presentation there. You want to just go up and down just to make sure it's working?
Okay. Let me know if it is.
That's it. You got it. All right. I think that we are ready to go. So I'm going to exit here and then you take over. All right.
All right. Fantastic.
Okay,
Thank you.
exiting now.
All right. A very good afternoon to everyone. My name is Raj Sethi, and I'll be presenting to you the valuation report for TotalEnergies. As we can see, re-ratings outlook is to growth. I initiate coverage on TTEF with a buy recommendation based on a target price of $92, implying an upside of 32%. I drive my target price based from a DDM-based valuation using a COE of 10.5% and a terminal growth rate of 1% given the maturity of the company. Some of the highlights that we'll be looking into while we delve into the details of this project are TotalEnergies' robust portfolio, new material CapEx investments, growing resilient upstream operations to meet emerging market demand, and some optimism around its earnings and scaling market presence. However, let's not forget the fact that there are some risks associated as well with regards to increased price volatility, geopolitical influence on free trade, and government interventions which are impacting the macro environment of the industry. Let's take a quick look in terms of the background. The company was founded in 1924. TotalEnergies is a French multinational that operates as an integrated oil and gas company that explores, produces, and refines oil around the world, with its main revenue derived from oil and biofuels, with a production capacity exceeding 1.5 million barrels per day. The company is listed amongst the top 10 oil and gas companies across its key markets, namely France, the rest of Europe, and North America. Energy mix drives growth and endorses transition strategy. The company's objective of tripling the amount of renewable energy and doubling energy efficiency by 2030 remains strong, with disciplined CapEx investments of $16 to $19 billion maintained over the next 5 years. The company is also very well on track to deliver over $100 billion in accumulated free cash flow over 2028, which could enable growth and uphold shareholder confidence. A quick look in terms of their upstream operations. The company plans to increase its production by 2 to 3% per year out to 2028 on the back of emerging market demand and expansion in LNG, with explosive growth in the developing world, particularly in China, India, and Southeast Asia. And the company has recently acquired TotalEnergies, valued at $4.2 billion, leveraging capacity in solar, wind, hydroelectric, and storage projects, all contributing to high-quality operated assets. The company is also in advanced discussions with Oman National Oil to develop a dedicated solar plant to cover 100% of the annual power consumption in the Middle East. Interestingly enough, this is a joint venture owned 80% by Total and the remaining by the National Oil Company, and is a plant that is driven 100% electrically with the lowest greenhouse gas emissions ever built worldwide. In terms of the optimism around its scaling market presence, they've recently signed an agreement of delivering 1.1 million tons of LNG per annum for the next 10 years, starting from 2027, which allows them to strengthen its long-term presence in Turkey. Additionally, its partnership with Petronas for CO2 storage in the Malay Basin reinforces its Asia presence. As the end of 2024, the company had $23.2 billion in cash and cash equivalents against $11.2 billion in short-term debt. The company is projected to maintain a strong financial profile over 2024 to 2027 with robust organic cash flow generation and sufficiently large cash balances to fund substantial CapEx investments. A quick look in terms of the industry as a whole, we can see that the present global energy landscape houses some of the biggest companies that ever exist, with a total market cap of $7 trillion, and this is projected to increase to $9 trillion by 2021, with a CAGR of 3.7% from 2024 to 2031. There are several key players in this arena, as you can see on the chart on the right-hand side, with Saudi Aramco having the biggest market cap. The overall oil and gas industry operates in three segments, with all of the majority players operating on all three segments. There has been a slowdown driven by lower demand in China in terms of oil, with the world's being the world's largest crude oil importer, which stems from rising natural gas usage and slower economic growth. If you look at the energy transition, renewables as a disruptor of the global energy scene, the current wave of energy transition is disrupting the global energy scene, with major disruptor being renewable energy. And the consumption could grow by 1.8% in 2024 in itself. The energy investment is set to exceed $3 trillion for the first time in 2024, with $2 trillion of that going into clean energy technology infrastructure. Moving very quickly on to their quarterly earnings, we can see that the first and second quarter TTEF experienced a slight revenue decrease, and the company saw less than 1% impact on its gross margin and slightly flat net margins. In terms of some of the latest news that are revolving around the company, they launched a floating offshore wind pilot project to supply renewable electricity to an offshore oil and gas platform in the North Sea, and they're on its way to decarbonizing the French industry by signing new agreements with Saint-Gobain. A quick look at the general consensus estimates. 70% of the analysts are bullish and have issued strong buy and buy recommendations. A very quick look at the overall revenue structure. The refining and petrochemicals are integrated activities and constitute to the largest revenue segment, which includes refining, petrochemicals, and the supply and trading of oil. Being the second largest distribution amongst majors outside of North America, with close to 14,600 branded service stations and 60,000 charging points, contributing to 38% of its revenue, the company is set to achieve 150,000 charging points by 2026. The most profitable growth, however, is in LNG and power integrated value chains, as they encompass the key axis of TotalEnergies' strategy, with a revenue of 9% and 10% respectively. The net electricity production from natural gas was 14.5 terawatt hours in 2023, as against 22.8 in 2022. And with disciplined capex dedicated over the next 10 years, the company is set for further growth in this segment. Quickly moving on to the FBMR framework, we can see that TTEF is neutral compared to 240 non-financial companies in France, allowing for fundamentals, valuation, momentum, and risk. With regards to the fundamentals, we've seen a gradual increase in margins and an improvement in recurring return on equity. And as for the valuation, it's moderately attractive, as TTEF trades on a low PE and an improved price to book ratio. A quick look at the benchmarking, world-class benchmarking. We can see that the profitable growth has shown low ranking, between 40 to 60% amongst 300 large energy companies worldwide. And in terms of its growth, it has its best period in 2021, ranking in the top 20%, but since has dropped to number 5. A quick look at their profit and loss statement. We can see that they are increasingly doing well in terms of their EBIT margins as we progress into the projected year, which is also having a substantial increase in terms of their net profitability. In terms of a quick look of their balance sheet, as I had mentioned earlier, they have a long-standing commitment in terms of building their infrastructure. And with that, we can see that the next net fixed assets is growing in towards the projected 5 years. Their liabilities and equities, they are extremely efficient in managing their overdrafts and short-term loans, and the long-term debt has been fairly stable across the period. In terms of their cash flow statement, as we can see, the dividend payout has been fairly stable and is projected to grow over the projected period as well. A quick look at their ratios. Current ratio is quite stable. In terms of the cash conversion cycle, they have been extremely efficient in the way they manage their receivables collection period, and in terms of the way they manage their inventory and defer the period with strategic negotiations with their suppliers. Continuing on ratios, we can see that the return on equity is fairly decent at 22, and the dividend payout ratio increases over time as the company projects to make better earnings. In terms of their free cash flow, as we can see, depreciation is quite stagnant, is quite stable across the years, and the capex is actually increasing. So that means the cash infusion is going into both arenas, one for maintenance as well as growth in terms of increasing and accelerating their pace on gaining market share. A quick look at the relative valuation. On the forward 2025 PE multiple, TTEF trades at an inexpensive range to the energy sector in the US, Asia, and Japan, and the world. And thus, TTEF seems inexpensive on a PE basis, trading at a PE of 6. I expect its EPS growth to be 24.4% positive in 2025, as the company aims for $8 billion in share buybacks in 2024, offering over 45% cash flow return to its shareholders. In terms of the valuation and target price, I assume a risk-free rate of 3% given France's 10-year government bond yield and equity risk premium of the market at 7.5%. The company trades at a beta of 1, indicating the stock moves identical to the overall market, resulting in a COE and a discount rate of 10.5%. I forecast a capital structure with around 26.4 debt to total equity, which results in a WACC of 8.6%. In my base case scenario, I anticipate a gross margin of 28%, leading to a value of $92 per share based on the dividend discount model methodology, which represents a 32% upside compared to the current market price. In my sensitivity analysis on the following page, the optimistic side assumes a gross margin of 30%, resulting in a target price of 102. Conversely, in the pessimistic side, the gross margin is assumed to be 26%, yielding a value of $82 per share. And to conclude, in terms of some of the risks, we can see that the realities shaping the global future of energy, increased price volatility and uncertainty, ongoing tensions in the Middle East, the Russia-Ukraine war, the US-China trade war are having a major impact on global oil prices. Geopolitical influence on free trade, economic sanctions combined with export controls can target those countries in which TotalEnergies operate, restrict certain types of financing and access to critical technologies. And last but not the least, government interventions impact the operational efficiencies. Governments and state-owned companies impose more stringent regulatory conditions, increasing the overall business cost. With that, ladies and gentlemen, I would like to conclude that there is a huge potential upside with TotalEnergies as a safe investment. Thank you very much.
Interesting. Excellent. So is this, I was looking at your free cash flow, and I know one of the questions that you've gotten a lot of questions from Mohammed. He really has got some good ones, but his first question is about asking why not use DCF or free cash flow rather than dividend discount model. And if you go back to that page, maybe when you explain that, then I'll have some other questions for you.
Am I on the right page there?
Correct.
Okay, well, I think one of the primary reasons of not using a DCF model is because the energy sector is actually quite cyclical. And TotalEnergies has been a very stable company with very stable dividends over the past period. Therefore, looking at their historical data and projecting a dividend model paying out forward is much more, it's much more better.
And if somebody says, okay, I appreciate what you just said, but I'm going to value it on free cash flow, do you think that your free cash flow valuation is realistic, or do you think that you're being too aggressive? I mean, how comfortable are you with what you're coming up with your free cash flow?
Well, I mean, one of the primary reasons I didn't go with the free cash flow is because, again, this is a very cyclical business, and taking into assumptions in terms of our revenue growth, net margins growth, and the assumptions that we're actually putting into the DCF model, it does project a very, very large increase over 150%, which I don't think would be manageable or even sort of convincible for investors to move forward with. And that's primarily the reason why I've actually leaned towards a DDM model rather than an free cash flow.
Okay. And Mohammed also asks, what do you mean by storage projects that you mentioned for Total EREN company?
So Total EREN is basically onto solar and hydroelectricity. The storage projects basically is to do with CO2 with regards to its partnership in Malaysia.
And he also asked, what about oil prices. You didn't mention much about oil price, and also he mentioned about Iran and issues there. How significant is it one for one in oil prices for this company, or is it more diversified? Or tell us more about the correlation between oil price.
Well, I think if you look at the overall revenue segment, I think the biggest revenue generator is coming in from its crude oil refineries, and of course they are basically very much dependent on the fluctuations in the oil market. Their dominant marketplace has always been Europe, and I think they are basically foreseeing that the oil prices will sort of stabilize to about 80. But however, if you look at the projected growth over the next 5 to 10 years, they are taking a two-pillar strategy. So one is developing their revenue base on the current oil business, but also leveraging out towards renewable, where they can actually see much bigger margins and contributions coming into the company.
So let's talk about renewables. If we look at, let's say, renewables today as a percent of total revenue versus, let's say, 5 years from now or 10 years from now, what is it like right now, and where do you expect it to be?
Again, going back to what I had earlier explained, I think they have a very clear two-pillar strategy, and I think they've been actually growing their LNG terminals in Mozambique and Papua New Guinea or the United States, and it's one of the largest amongst its peer group in terms of investing into the LNG, natural gas renewable space.
And
So in the next,
is natural gas considered renewable by them, or is that considered
so LNG and electricity, electrical power is basically considered under the renewable category for them.
right? Okay. And another question from Priyanka. She asked, is it true they're moving into copper trading? How do you see this diversification affecting the company's risk profile? Is that the case? Are they doing copper trading, or is it small, or is that
Well,
big?
I think there are rumors around this. The company is basically looking at understanding what that segment would mean. But I think if you look at it from a revenue perspective, I don't think the contributions would be anywhere close to impacting their overall revenue structure as of today. But would that be something that they would look at in the next possible future? Possible.
Okay. And also, Mohammed asks, and for China, I think the economy could grow again after dealing with the real estate sector, since China's number 2 in demand for oil. What are your expectations, and what are you expecting in your forecast and the like when it comes to China and this company?
Well, I think that's a very, very interesting question. The way I look at TotalEnergies amongst its top 10 key players within the industry, I think TotalEnergies' dominant markets have always been Europe, including France, and not Asia. So therefore, that's the reason why I see that they have a potential of real upside and real growth trajectory. China, of course, being one of them. And I think with that being said, they are strategically starting to get into the emerging markets with joint ventures and smaller acquisitions. So I'm pretty optimistic that within a 5-year period, they will be able to find their way in towards the China consumption for oil.
We got a lot of good questions, so I'm going to keep them rolling, and you're doing a good job. You're doing a good job answering them.
Thank you.
If there's okay, so this is from Kumail. He says, if there's a lot of projects going on, what makes you think that it's only going to be 1% terminal growth? Why not a higher terminal growth rate?
Well, I think considering that this is a very mature company, it's only decent to actually keep it at 1% at this point in time. If that actually changes over the next 5 years and their projects become lucrative and they are able to sort of infuse more earnings into the company, one may consider a different terminal growth rate. But I think at this point in time, we're basically going with an industry average.
Okay, we've got another question from Antonio Lissi. It says, are you considering the risk behind nuclear power and renewable in the next 20 years? I'm not exactly sure what that risk is, but if you have any thoughts on nuclear power, is there any involvement with that, or what's the situation there?
I think within their potential pipeline of new projects, there are discussions revolving around nuclear power, but I think from an investment perspective, they haven't really taken very much of a stance. So I don't really see that hindering with their current infrastructure and strategy development over the next 10 to 15 years.
Okay, can you go up to your cash flow statement?
Sure.
Not the free cash flow, but the cash flow. There.
Got it?
Okay. Superwan asks a question. It's a very observant question, and it says, why do you expect the dividends paid to grow so fast in the future years when the actual numbers seem to look pretty stable at, let's say, 8, 10, 8, something like that. Curious, particularly when you're valuing it using DDM, is there a risk that you're overly optimistic in your dividend payment, or what are your thoughts there?
Well, I think, I mean, I did give that a very serious thought when I was working through my forecast. And the way I see it, I think the revenue projection that I have actually forecasted is increasing at least by about 30 to 40% with its net earnings in line with its revenue projection. So therefore, when there is a sufficient amount of cash flow within the organization and a sufficient amount of free cash, I think it is only right in order to actually share those profits with your shareholders so that they can stick with you as investors for the long run. This gives you the avenue of actually utilizing those investments for future growth potentials in the next 10, 20, 30-year horizon.
And I'm assuming that the change in equity that's negative here is share buybacks, probably.
That's correct.
Yeah. Okay. So if we look at 2028, we can say about 25 billion in between dividends and share buybacks. Interesting. Can you go up to the top page? Maybe just press home. Hopefully that would get you there.
Oh, sorry. Just go back. Is that the one you're looking for? Sorry.
Yeah, that's it. We got a good question from Sierra Road, and he says, what's the main catalyst that's going to bring the price up to your target? The stocks, you can look at the share price and see that we've been drifting down from a prior high, it looks like. What is it that, do you think that this is going to turn around immediately, or we have time to get into this? What are your thoughts?
Well, I think my calculation is based over the next 6 to 12 months. So therefore, there is definitely an upside, and it's probably the right time to get into the markets because there is a 32% upside in terms of the stock valuation. And I say this purely because of the reason that they have quite a number of new projects where they're actually winning and also increasing their market presence. So this is actually signaling to the market a lot of optimism in terms of where TotalEnergies is and where they ought to be in the near future.
So how does it feel to graduate from the Valuation Masterclass Bootcamp?
I think it's been an amazing journey. Compressing 200 hours within a 6-week timeline, I think requires a lot of dedication and a very high level of commitment. And a big thanks to you and the entire faculty, and especially Moment, to have put together such a wonderful program.
Yeah, isn't it amazing? I'm sure as you were going through it, you're thinking, holy crap, this is much more than what I thought it was going to be.
Absolutely.
It's the hardest part is, we want to bring a transformation, and you got to bring a certain amount of content.
Correct.
But the hardest part, Raj, is removing content and say, no, we'll put that in professional, because there's just so much we want to include. So yeah. How would you describe like the transformation that you've gone through? What's different about you today than when you first came in?
Well, I think two things really spring to mind immediately. One is I think I've become a lot more efficient in terms of my research, finding evidence-based data to utilize in my assumptions forward. And the second thing is I come from a non-finance background. So having to go through this journey and today basically understanding the story behind numbers gives me the confidence to be able to look at any business and be very curious in terms of how efficient is this business, or how efficiently are they using their cash. And I think that for me is a huge change.
Yeah, that's exciting. And when you think about it, you're putting the pieces of a puzzle together. And the great thing is that you started with puzzle pieces all over the place at the beginning of the boot camp, and here you've completed the puzzle. So
yep.
What remind us how you found out about the Valuation Masterclass Bootcamp, and what was it that made you decide to do it?
Well, I mean, I've gone through 2 retrenchments in 2 different countries in the past 2 years, and I was talking to very close friends with regards to what I should be doing in terms of my next step. And I've been looking at investments for my family quite seriously. And I think I was suggested that understanding the foundation of finance and investments and valuation would actually give me that competing edge when I'm looking to construct, I would say, a risk-averse portfolio.
Mm. Yeah, exciting. Well, you've learned all the main parts. That was a great presentation, and I learned a lot about the company and excellent questions and great responses. So congratulations, and I'm going to talk to you in just a minute, but I'm going to wrap up here. Well done.
Thank you very much.
Yep. Wow, that was great. What a complete analysis of TotalEnergies. And, it really was fascinating, as Raj mentioned. And here we can just see a comment that just came in that says, that's inspiring for a non-finance background. Great work coming in, great feedback here. Another one, great presentation. The point is that I've tried to design the Valuation Masterclass Bootcamp so that anybody could come in, even with no finance background, as long as they have a desire to learn. And I think Raj has just demonstrated a great result of coming in from basically zero and being at a point where he can analyze a company very, very well. So if you're not a finance person, but you need to learn finance and valuation and understanding about companies, why not join us in the Valuation Masterclass Bootcamp, just like Raj did? Just go to valuationmasterclass.com and I'll see you there. My name is Andrew Stotts, and I can't wait to see you in Bootcamp number